All right, hey, welcome back to Principles of Accounting 2. Um, yeah, we made it through the first week. That's awesome. I'm so happy about that. It makes me feel great. And seeing all of your progress is super important to me. Um, remember that everything for each week is due Sunday night. So it's really important that we stay on top of that work. We don't want to fall behind because ultimately it's just going to hurt ourselves. And so my best advice to you is just to keep up that momentum. I just want to quickly show you in the classroom where we are today. So here in the classroom, we're within week two. Last week, which was the first week, we had a couple things going on. You had a LinkedIn Learning certificate called Accounting Foundations, and then you had to upload that certificate here. So you want to engage and explore. You opened up the accounting foundations. It should have launched pretty easily for you as long as you had um, linked your account appropriately. You'll watch all the videos in order as they're being watched. The green check mark will appear on the left side. You go through every single video. It should take you like maybe an hour and a half or so to get all through all of them. At the very end, a window will open up. It'll show the certificate. You'll click on that part, and then you'll be able to download that as a PDF. And then from there, you go back to the classroom and you upload it to Action and Expression folder, and that's it. Nice, simple, easy to do. But just if you haven't done it already, please make sure that you do it as quickly as you can, so that way I can get you up to speed. So that was week one. Here we are in week two. Today we're going to be talking about how we analyze the financial statements. For this week, the nice thing is it's a really easy week. All you need to do is, especially that you're here, it's going to make your life a lot easier. But, take your notes, whatever you need to do. The video will be recorded. There's also the PowerPoint presentation and the instructional materials. So you just watch, you can download the presentation, whatever you need to do, take notes. It's there in instructional materials. And then when you feel ready, go ahead and take the quiz for chapter 17, which is what we're going to talk about now. So thank you all so much for your time today. Appreciate you being here. So let's go ahead and jump in on our discussion about how we analyze the financial statements. Now, the first thing I want you to do is kind of recall what the financial statements are, because it is so important that you know what the financial statements are and how we interpret them. So just to kind of jog your memory, we have the income statement, which represents all of the sales minus cost of goods sold equals gross profit minus your operating expenses equals operating income minus your taxes and interest expense, and then we get to net income. All right, that's all on your income statement, your sales and your expenses. Then on your balance sheet, we have the asset account balances, liability account balances, and your equity account balances. So assets is what the company owns, liabilities is what the company owes to someone else, and equity is what the owners own, right? And then we have our statement of retained earnings, which shows us changes in ownership within the business. Beginning balance retained earnings plus net income minus owner's withdrawals equals ending balance retained earnings. And then we have our statement of cash flows, shows the cash coming into and out of the business for operating, investing, and financing activities. So those were the four basic financial statements that we learned about back in Principles of Accounting 1. Now, taking what you recall about Principles of Accounting 1, it's also very important for us to really understand exactly what is going on in the business. And we do that by analyzing those financial statements, which is what this is all about. So I want to talk about the tools that we use to analyze those financial statements and really how all of that works. Um, so we use what we call the uh, the building blocks, right? So first I want to talk about why we analyze the financial statements. Why do we go through this process of, using things like um, all of those ratios that we learned at the end of each chapter. Why we use things like horizontal and vertical analysis to analyze the financial statements, to look at the trends, right? So why do we analyze financial statements? The reason is because we as managers need to be able to understand the company's overall financial health and performance. We need to be able to evaluate the company and give it better direction and make effective decision making, right? That's why we as managers evaluate the financial performance of the company through analysis of the financial statements. External users also need to do this because they need to make decisions about investing in the company, lending money to the company, providing goods and services to the company. Right? They need to be able to understand it for their own goals. So the overall purpose is to understand the financial performance of the company, to evaluate it based off of its past and current performance, the current financial position, and to understand future financial risk of the company. And all of these internal and external users need to be able to see and understand that financial analysis to make decisions about the company. So that's why we analyze the financial performance of the company. We analyze the financial statements. So, how do we analyze the financial statements? Well, we have to first look at the building blocks of those financial statements and how we analyze them. The first area that we look at is what we call liquidity and efficiency. What do you think liquidity means? Any guesses? Any thoughts? What do you think liquidity means? What does that mean? What does it mean to be liquid? Tanika.
Like an asset that you can like have on hand, like money.
Yeah, yeah, exactly right. I love it. That's a fantastic response. The
Is
idea,
there like assets?
yeah, exactly, Caleb. So what we're ultimately doing here is we need to understand how quickly we can convert those assets that you just described, Caleb and Tanika. We look at how quickly we convert those into cash, right? That's what liquidity ultimately means. And with liquidity, it helps us to meet our short-term debt. We have to pay our short-term debt. We've got to make sure we have enough cash to do that with. So we have to make sure that we are liquid enough to do that with, right? So that's what liquidity ultimately means. So very well done. Yeah, so liquidity and efficiency, we've got to make sure the company has the efficiency to generate sales. We also look at this thing called solvency. Solvency represents the company's ability to pay their long-term debt through generating future sales. Okay, that's what it means to be solvent. I can generate enough sales to pay all of my debt. That's solvency. I can effectively go out of business, and that's a good thing because that means I'm solvent. I can pay all my debt and go out of business and be happy. Solvency. We also have this other thing that we look at called profitability. That's why we're in business in the first place, y'all. Got to be profitable. Make a profit. That's why we're selling products. That's why we're providing service. We're in business to be profitable. So profitability, we're looking at the company's ability to generate a profit, you know, and to of course attract new financing from new investors. And then we also look at what we call market prospects. This is a company's ability to generate positive market expectations. What I mean by that is to have a nice, stable price per share for the company's stock price, and the company's ability to generate future cash flows through market investments. So those are the building blocks that we use to analyze the financial statements. So what do we need to be able to do this analysis? Well, of course, we need the financial statements themselves. The income statement, balance sheet, statement of equity or statement of retained earnings, and the statement of cash flows. We also look at these things called the notes to the financial statements. This is additional information that supports the financial statements. It gives us additional information behind some of those balances, okay, through these financial reports. And so that all of that information we use to be able to analyze the financial performance of the business. Now, when we measure ourselves, we need to be able to measure ourselves against something, right? We need to be able to compare ourselves to something, to benchmark ourselves to something, okay? When we analyze financial statements, we need to be able to compare ourselves or benchmark ourselves. And we can do that to a couple different things. We can look at what we call intra-company performance. This is the company's current performance compared to the prior year's performance in financial terms. Okay, looking back, I'm looking at what happened last year in comparison to this year. Intra-company performance. I can benchmark myself to my competitors. For example, Coca-Cola can compare themselves to Pepsi based off of their profit margins. They can compare each other. I could benchmark myself against my industry standards. For example, Intel's profit margin can be compared to the semiconductor industry performance. And I could also benchmark myself against guidelines that are set based off of experience, right? Like a 2-to-1 ratio or 1-to-1 type of ratio. Guidelines. So these are the four standards for comparing our financial performance to be able to benchmark ourselves, right? That's how we measure our performance because we have to compare it to something. And that could be one of these four things or all of these four things. So, how do we deal with it? We know what we need to do. We need to measure ourselves against one of these four things, but how? We do it in these three ways. We use these three tools to analyze the financial statements. The first is called a horizontal analysis. And just as the name implies, I'm looking across the horizon. I'm looking across time. I'm comparing my 2025 results to 2024's results and to 2023's results. Okay, I'm looking at each line item on my income statement and balance sheet, and I'm comparing 2025 to 2024 to 2023. Right? I'm looking across time. I'm looking across the horizon. We call that horizontal analysis. I can also do this vertically. I can look up and down my financial statements and compare year to year based off of a specific base amount and express everything as a percentage. through vertical analysis. On the income statement, I express everything as a percentage of total revenue or total sales. Total sales is 100%, and then every other line item on the income statement is based out of total sales. So cost of goods sold divided by total sales is the percentage of the cost of goods sold in comparison to total sales. Rent expense divided by total sales tells me the percentage of my rent compared to total sales. And you see where we'll go with that. Every single line item on my income statement is expressed as a percentage of total sales. On my balance sheet, I express everything as a percentage of total assets. So, for example, if I want to know what my percentage of cash is in comparison to total assets, I'll take my cash amount divided by total assets amount to get my percentage of cash to total assets. If I wanted to know something like my total or my current liability percentage of total assets, I take my current liability total divided by total assets to get my percentage of current liabilities to total assets. And I can do that with every line item on my balance sheet. The reason why I do it that way is because I can compare year to year based off of percentage, the percent change year to year. Okay. I could also compare my company's performance to other companies that are of different size. For example, Marriott Hotels can compare their income statement and balance sheet to Hyatt Hotels that reports differently and they're of different size. And the way that they can compare each other is through vertical analysis by expressing everything as a percentage. You see? So that's how we use vertical analysis. And lastly, one of the other tools that we use on a common basis is ratio analysis. This, of course, measures the relationships between financial statement items, right? And you know a lot about ratio analysis already because back in Principles of Accounting 1, we did them every single week, right? So I'm going to show you all three tools, how they're applied to our financial statements for us as managers to make effective decisions based off of that information. So first I'm going to show you how horizontal analysis works. As I had mentioned already, horizontal analysis is a look across time from left to right. I look at 2025 compared to 2024 compared to 2023. All right. Across each line item on the income statement and the balance sheet, it shows me what's happening across time. Horizontal analysis. Okay, that's the whole idea behind it. Now, when I do that, I need to look at the difference in terms of dollar changes and percent changes over time. When I compare one year to another, I can look at the dollar change and the percent change. The dollar change, real simply put, I take the analysis period amount, which is the current year or most recent year, and I subtract out the prior year or the base year. When you see the term base year, it's typically whatever year is oldest in the data that you have. Okay, that's really what it refers to. So if I'm looking at 3 different years, the base year is the oldest year. So it'd be 2023, for example, 2025 compared to 2023. So when measuring them, we do it in terms of dollars. Very simple. We take the most recent year, which is the analysis year, and we subtract out from the base year. That gives us our dollar change. Very simple process. We also do this as a percent change from year to year. And the way that we calculate that percent change is we take the analysis period amount minus the base period amount divided by that base period amount. And then we multiply that by 100 to get the percentage. Real simple process. And what that does is it shows me the percent change of each line item from year to year. Now I'm going to show you an example of Apple's most recent data. So here I have Apple for the current year in comparison to the prior year. And this is for their balance sheet. So we take the current year minus the prior year to get the dollar change. To get the percent change, we take the current year minus the prior year divided by the prior year to give us the percent change. Now, I'm going to ask you all a question. What do you think, as a manager, you would want to look at as being an important change? What do you think? Take a look at this balance sheet and what line item would you think would be like a super important change?
Like total assets.
Was that you said total assets or I'm sorry, Lizette, I didn't quite hear you there.
Yes, total assets.
I'm sorry, you cut out there. It sounds like you're in like a wind tunnel or something. Sorry about that. You can always type it into the chat too. Uh, any any thoughts? As a manager, you're looking at this and you're like, "Oh, wow, that seems significant," and you want to look at it more. Caleb,
Like they said, total assets,
you want to look at what? I'm sorry.
total assets.
Total assets? Why is that?
I feel like that's the like everything, the total basically, like everything came together, and that's how much you made that
Sure.
current year.
Yeah, you're right about
And
that,
then
but I'm wondering why, because the percent change is zero. So I don't know why as a manager you think that that would be important to look at.
you're right, I didn't see that part. Um, so you would want to focus on the higher percentage.
Sure, yeah. So give me an example of which one and why you think we should look at it.
Probably the inventory, 28%.
Yeah, I like that one. The good one. Very good. Yeah, so yeah, as a manager, I'd be interested to see what happened there. So we can take a look, and so we see that the current year is $6,331 in terms of current inventory, and last year was 4,946. And so what that tells us is that there was a dramatic increase in inventory. So it went up by 28%, in fact. And so I'm curious as to why that happened, right? So as a manager, I would want to do some digging. Maybe we made a lot of purchases in terms of inventory and we just haven't sold through it yet, or something along those lines. But the point that I'm trying to get at here is that you want to identify areas where of significance, where the larger changes are, and explore why those changes happened. It could have been for various reasons, but it's important to understand as a manager what happened here and what can I do in the future to ensure that we are being efficient with our resources. I'm sorry, Lizette, it's still super fuzzy. I don't know what's going on with the microphone.
Okay, never mind. Yeah, I don't know why it's like that.
I I can almost hear you. Almost. I heard okay, never mind, and then I hear the fuzzy noise. But I'm sorry about that. It just must be the technology. You know how it goes. But yeah, feel free to if you want to type it into the chat. That works as well. It's okay. It's okay. There's no need to apologize. It's all good. But I just appreciate you being here and being able to participate. Yeah. So no worries. All right. So we looked at the balance sheet. We can do the same exact thing with look wondering why. Oh, great question. Okay. So Lizette is asking, I am just wondering why we wouldn't look at the assets when the percentage is zero. Yeah, so the reason why we wouldn't care too much about that is because there was no change. There was no real change in terms of the total assets. So as a manager, I just wouldn't care as much. Because there's no trend there, right? It's just kind of a flat trend. And sure, there's some importance there. Why is it still the same from year to year? Good question. But it's just not as significant as like a large percent change would be. So as a manager, I'm concerned about controlling my expenses, controlling my costs, looking at my efficiency. And so when I run this type of horizontal analysis out, I'm going to focus my attention on those larger percentages because it tells me something big and important happened here to cause this to happen, right? And so I want to dig a little bit further into those transactions that caused that change to happen. Does that hopefully that makes a little bit more sense to you? But I just want to make sure that we understood why those smaller percentages just don't have that same weight to them, if you will. So hopefully that helps to explain a little bit more. So thank you. Appreciate it. Love the questions. Um, we also do the same thing for the income statement. So here we have Apple's most recent income statement, and we have our dollar change, so current year minus prior year, and percent change, current year minus prior year divided by the prior year to get the percent change. And just at looking at this income statement difference, I'd be super curious to find out what's going on with research and development. 14% change from year to year. Maybe that means that they're working on a new product, right? There's a good chance. That's what that could indicate. I'm also curious about what happened with other income. Don't know what's going on there. Confusing. Minus 69%, big number. I'd want to look into that as well. I see that our net income went down by 2.8%. That's a concern for me. I'd be very curious as to what caused it. I know that our sales were a little bit lower. So maybe that was the cause, but I also see that our research and development's a little bit higher. So maybe those changes are deriving the total change in net income to be lower. So things to look at as a manager. It's good to be curious about big changes in the business's financial performance from year to year. So that is our horizontal analysis. If we looked at more than just 2 years, we could compute what we call a trend analysis to look over several years of data. Now, a lot of times within a 10K report, which is an annual filing, companies provide the most 3 recent years of data. You could also go further back and look at multiple years of data as a manager and understand what the trends are in the business. And so you would compute what's called a trend analysis or a trend percentage. And to do that, we take the analysis period amount, we divide that by the base amount and multiply it by 100. The base amount is always going to be the oldest year of data. So here I have an example of this. I have 5 years of data here. The base amount, as you can see, is the oldest year, so 4 years ago, is 100%. And so the way that it works is I take the analysis amount and I divide that by the base amount to get, I take the analysis amount by the base amount to get the percentage. So, for example, net sales 3 years ago was 274. The base amount was 260. So 274 divided by the 260 is 105%. 2 years ago, 365 divided by the 260 is 140%. 1 year ago, we had 394 divided by base year 260, 151%. And then current year, 383 divided by the 260, 147%. The reason why we compute the trend analysis is to show us the overall changes over a larger period of time. Right? That's the whole idea behind this. We can also display that information graphically. And just like I may have mentioned this before, I've come across a lot of business owners that really just don't get their numbers. They don't understand things. And so I try to show them graphically. So when you graph it out, it helps to make those changes over the 5 years a lot more understandable. Right? So here we can see the net sales, cost of goods sold, and the operating expenses graphed out over the 5 years. And this helps us to really understand the overall trends of the company. So that is trend analysis with using your horizontal analysis. The next thing I'd like to talk about, which is the next tool, and that is the vertical analysis approach. As I had mentioned, we're looking up and down the income statement and up and down the balance sheet, and we're expressing everything as a percentage. Okay, so for the balance sheet, we express everything on the balance sheet as a percentage of total assets. On the income statement, we express everything as a percentage of total revenue. So we would take an analysis amount like cash, for example, divided by total assets, and that will give me the percentage of cash derived from the total assets. Okay. On the income statement, I can look at something like cost of goods sold as a percentage of total sales, right? That's a really important number to know because as a manager, I need to be able to control and evaluate my performance and my costs. So that's why we go through this exercise of expressing everything as a percentage of total assets or total revenue, depending on if we're looking at the balance sheet or the income statement. So the formula we use here is the analysis amount divided by the base amount times 100. And the base amount is either going to be total assets or total revenue, depending on if we're looking at the balance sheet or the income statement. So let's use Apple's information again, just like we did before. But now what we're doing is we're expressing everything as a percentage of total assets by looking at their balance sheet. So as you can see, for the current year and the prior year, total assets expressed as 100%. And the way that it works is we take the analysis amount and divide by total assets. So for example, for the current year, the company has $29,965 in cash. We divide that by the $352,583, and that gives us 0.085 or 8.5%, which means that out of our total assets, only 8.5% of our total assets is in the form of cash. We go through that same process for every single line item on the balance sheet for each year. This is really easy to do, especially if you do it in Excel, right? It makes it super easy for you. Now, we can see that we have some really interesting numbers here. Now, for me as a manager, I'm really interested in this accounts payable number. And I'm also interested probably in the long-term debt number. interesting numbers here, in my opinion. So take a look. For the current year, accounts payable sitting pretty at 17.8% of total assets. Ooh, that's to me, that's maybe a little high. I don't know. It depends, right? So to me, that could be a concern. What it tells me is that maybe the company doesn't have as much current assets as they should, because they have high accounts payable. I don't know. I don't know. So I'd want to look further into that as a manager. I'd also be curious in the long-term debt sitting at 27%. That's kind of a high number, at least in my opinion it is. That's a little concerning. Tells me the company might be a little too much leveraged with respect to debt. So I don't, but I'm not quite too sure. But the cool thing with do this type of analysis is that I can compare year to year based off a percentage, and I could also look at as everything expressed as percentage of total assets. This gives me a lot more insight into the company's debt to equity and things like that, right? So that's why I really like this. I can also use this to compare Apple to, let's say, Microsoft, just to kind of do a side-by-side comparison with them, from a benchmarking and competitive analysis perspective. And I do the same thing with the income statement. The income statement, we express everything as a percentage of total sales. And so that's why at the top you see net sales being expressed at 100%. So I take whatever it is, like cost of goods sold divided by total sales. In this case, for the current year, it's 55.9%. I think that's good. That's actually a really good cost of goods sold. The margin is fantastic, 44%. Um, Operating income sitting really looking great at 29.8%. And net income at 25%. So overall, in my opinion, the company's looking great. Very healthy. Just from this common size financial statement analysis or vertical analysis, and expressing it this way is really helpful as a manager because it gives you a kind of a full picture of where things sit as it relates to total sales on the income statement and total assets on the balance sheet. So just take it into that context that it helps you as a manager to be able to make decisions about the company based off of percentages, right? Just puts things a little easier for you. We can also graph and chart this type of data, which is extremely helpful because, just like I said before, not everyone understands the numbers behind their business. And so I like to make these types of charts and graphs for management because they don't necessarily know how to read the financial statements like that. And so showing them graphically is really, really important. And so we're able to visualize our costs in relationship as a percentage based off of the vertical analysis. And so this is what this kind of shows us. And overall, I think it's a great way to explain the financial performance of the business to people that don't understand accounting. Yeah. So yeah, charts and graphs. We could also do the same thing for comparison analysis. We can compare company to company based off of their performance using charts and graphs as well. Yeah. So that's one of the great things with being able to visualize data. It helps us to make good decisions for the company. So we talked about horizontal analysis, we talked about vertical analysis, and now it's time to talk about the third tool, which is the ratio analysis. And I'm sorry, there's a lot of these. Okay. There are a ton of ratios for you to know, or at least try to know. I'm at least going to show you how to they're computed. So I'm going to walk you through this in the best way I know how. Okay. So let's walk through the ratios. And just like I explained to you before, we break these ratios out based off of the building blocks: liquidity and efficiency, solvency, profitability, and the market prospects. And there are several ratios for each one. I'm really only going to touch on the important ones that every manager really should know. Especially if you plan to sit for any type of certification exam related to finance or accounting, these ratios will be really important to you. If not, they're still important to you as a manager because you need to be able to analyze the financial performance in a really quick way, and the best way to do that is through ratios. So first, let's take a look at those liquidity and efficiency ratios. And here we can see that there's a lot of them. There's working capital, current ratio, acid test ratio, accounts receivable turnover, total asset ratio, turnover ratio, number of days in sales and inventory, day sales uncollected, and inventory turnover ratios. Ton of them, right? So you don't need to memorize these. I just want you to understand what they are and how they work. The first one's going to be the working capital ratio. This one's really easy. It helps the company to understand uh, how much money the company has the ability to pay their current liabilities and what's left over. What's left over is called working capital. It's what the company has to work with to continue operations into the future. Yeah, real nice, simple ratio. So with this, we take our total current assets minus our total current liabilities. That gives us our working capital. So for Apple, current assets 143,566 minus the total current liabilities of 145,308. They have a negative working capital of 1,742. That's not very good. Okay, that's actually not a good thing to have a negative working capital. But it's not necessarily all bad news. It just means that the company really doesn't have the ability to be flexible in the future with respect to their operations. They probably need to pay down their current liabilities to be more flexible in the future. The next up, we have our current ratio. I love this ratio. It is super easy and super important to compute. The current ratio tells the company about their ability to repay their current debt. And with this, we take our current assets and we divide that by our current liabilities. And here we're looking for anything greater than 1 is considered good, right? Anything greater than 1 is considered good. Anything less than 1, not great. Not great, less than 1. And so for Apple's situation, it's less than 1. That's not good, but it's not the worst thing in the world. It just means that they're a little bit more risky when it comes to taking out any additional debt. The next up is the acid test ratio. The acid test ratio is also called the quick ratio. And this tells us a lot more about the company's ability to turn things into cash and how quickly they can do that in. So the way we compute the acid test ratio is we take cash plus short-term investments plus current accounts receivable, and we divide that by total current liabilities. Now, what that does is it tells us how quickly the company can convert things into cash. We purposely do not include inventory in this ratio. And the reason why we do not include inventory is because it's a little bit more challenging to liquidate our inventory, right? That's why we don't include it in this ratio. Next up, we have the accounts receivable turnover ratio. This tells us how frequently the company is converting their accounts receivable into cash, right? How quickly I'm collecting cash from my customers. That's what it tells us. Yep. So here we take our net sales or total sales divided by what we call average accounts receivable. To find the average of anything in accounting, we take the beginning balance plus the ending balance and we divide by 2. That's how you find the average. Beginning balance plus ending balance divided by 2 is how you find the average of anything in accounting. So in this case, we take net sales divided by beginning balance plus ending balance divided by 2 to find the accounts receivable turnover. And here we have for Apple, it's looking great. We have net sales divided by average accounts receivable turnover, 13.3 times. That's awesome. That's really, really good. That's a higher turnover, the better, right? It means that they're collecting their sales from their customers a lot faster than their competitors. Google at the time was about 7 times, and Samsung was about 7.2 times, just to give you an idea. So Apple's, doing great when it comes to collecting from their customers on account receivable. Okay. Uh, Sorry about that. Next up, we have inventory turnover. This tells us how long the company hangs on to their inventory before they sell it. So how long it sits on the shelves for. This is good information because we don't want it to be too high, right? And but also we don't want it to be too low because if it's too low, that means that we could run out of stock. If it's too high, that means we're not selling through it fast enough, right? So to calculate inventory turnover, we take the cost of goods sold and we divide by average inventory. Beginning balance plus ending balance divided by 2 for the inventory. So in the case of Apple, their average inventory turnover is 38 times. This is a little high, actually. It's a little high. It's higher than Samsung, um, which is good to some degree, but we don't want it to be too high because that means they might not be selling through the inventory as fast as they should be. So it's a good ratio, not the end of the world if it's, high. Next ratio is the days sales uncollected. This measures how frequently the company is collecting on their accounts receivable. Great ratio. I like this one. We calculate this by taking accounts receivable divided by total sales and then multiplying it by 365 days. In the case of Apple, it is 28.1 days, which is really good. If you compare that to what's going on with Samsung, Samsung's at 51.7 days and Google's at 57 days. So for Apple to be at 28.1 days is really, really good. It means that they're able to collect their sales very frequently, and you want it to be frequently because it shows that they have good cash flow. Day sales and inventory tells us how long things are sitting on the shelf, how quickly we're selling through inventory, right? So the way we calculate this is we take the ending inventory balance found on your balance sheet, and we divide that by the cost of goods sold found on your income statement. We multiply that by 365 days. In the case of Apple, it's 10.8 days, which is really, really good. That's excellent in my opinion. It means that they're able to sell through their inventory every 10.8 days. It means that there's good demand for the product. On the last one within liquidity and efficiency, it is called the total asset turnover ratio. Tells us how efficient the company is at using their assets to generate sales. This is an efficiency ratio. And to calculate this, we take our sales divided by our average total assets. Beginning balance plus ending balance divided by 2 gives us the average total assets. In the case of Apple, it's 1.09 times, which is pretty decent. No worries, Shantia. I get it. Yeah, 1.09 times for the total asset turnover. It's pretty good. Very good. It's an important indicator of efficiency. So now we've done efficiency and liquidity ratios. Let's move into solvency ratios. There are 4 primary solvency ratios that I want to talk about today, and that includes the debt ratio, the equity ratio, the debt to equity ratio, and the times interest earned ratio. The great thing is we can combine the debt ratio and equity ratio into the debt to equity ratio. And we can do that all on one really cool, easy slide. Okay. The reason why debt to equity is really important is because banks use this to evaluate the individual or the company's ability to take out debt. And so a bank will run these ratios on you when it comes to your ability to repay debt, right? So if you need to take out a loan, the bank's going to calculate the debt to equity ratio. Yep. So here's how this works. The debt ratio shows the total liabilities as a percentage of total assets, right? Very, very straightforward, very easy to do. So the debt ratio shows the total liabilities as a percentage of total assets. And the equity ratio shows the total equity as a percentage of total assets. Now, what this ultimately does is it shows the company's overall financial structure. Are they using more debt, or are they using more equity to finance the business? Right, that's why debt to equity ratio is super, super important. So here we can see the debt ratio sitting at 82.4%. And how we got there was we took total liabilities divided by the total liabilities plus equity. And that gives us 82.4% for the debt ratio for Apple. For the company, that means that they have a 17.6% equity ratio. And just as before, we're going to take the total equity, 62,146, divided by the 352,583, giving us the 17.6%. Now you can see that when we add the total debt ratio and the total equity ratio together, we get 100%, which represents the total financing structure for the company. This means that Apple is using primarily debt to finance their operations. And in looking at that debt to equity ratio, we compute that by taking total liabilities divided by total equity. This ratio, once again, great to understand the company's solvency, their ability to repay all of their total liabilities using their total equity. So, uh, in the case of Apple, we take the total liabilities divided by total equity, and we get 4.67. This is very high, and it indicates some risk on the company with respect to their liabilities. It tells me that they have a lot of debt and not enough equity, in my opinion. And so the larger debt to equity ratio implies that there's less opportunity for the company to expand through debt financing, meaning the banks are not going to lend Apple more money. 4.67 is really, really high. So Apple will probably want to raise additional funds through equity rather than through debt to be more attractive for investors. The last ratio within solvency is called the times interest earned ratio. This is the amount of income before taking out interest expense and taxes. This tells us about the company's ability to repay interest on loans that they've taken out. That's what it tells us. Yeah, the company's ability to pay interest. To compute this, we take the income before interest expense and income taxes, which is also known as operating income, and then we divide that by interest expense, and that gives us the times interest earned. In the case of Apple, they have 29.9 times, which suggests the companies, the banks, have very little risk of non-repayment. In other words, Apple's going to repay their loans, and the banks will collect the interest. No problem there. The third area we're going to look at with respect to our ratios is profitability. This is a company's ability to generate a profit, right? To show a return on the investment. And we're going to look at 4 ratios under profitability that are important. One of those being, in my opinion, the most important, which is the profit margin ratio. We'll also look at the return on total assets, the return on equity, and the gross margin ratio. All great ratios, all super important to calculate with respect to the company's overall profitability. The first one in this area is called the gross margin ratio. This is the company's percent of gross margin to each sales dollar, or each dollar of net sales. Gross margin is sales minus cost of goods sold. That gives us gross margin. So sales minus cost of goods sold gives us gross margin. And then we divide the gross margin by sales to get the gross margin ratio. Yeah, basically tells us what's the percent profit from each sales dollar. Is a way of thinking about this one. Really, really important. The other important one I like a lot is the profit margin itself. This is the company's ability to earn net income from each sales dollar. Real easy ratio, we take net income divided by net sales. In this case, for Apple, it's 25.3%. That's really good. That is really, really good. Obviously, the higher the better. At the time of this slide, Google was at 24%, Samsung was at 6%, and the industry as a whole was at 11% margin. So for Apple to be at 25.3% is really awesome. That means that their cost of goods sold in relation to their sales and net income is decent. It's really, really good. Just like we saw in their income statement. The next one to look at is called the return on total assets. And this tells us about the company's ability to earn a return on its total assets. So we use, obviously, the company uses assets to help us to generate profit. That's the whole idea here. So to calculate this, we take our net income and we divide that by average total assets. And in this case, uh, net income for Apple was 96,995 divided by the average total assets. We ended up with 27.5% for Apple. Amazing. Very, very good. Again, the higher the better here, and they outperformed the industry as a whole, which is really impressive. It means that they're using all of their assets to generate profit efficiently. Uh, and the last one within profitability is called the return on equity ratio. As the name implies, we're measuring the company's ability to earn an income for its owners, and the way that we compute this is we take our net income divided by average total equity. Remember, anytime you hear the word average in accounting, it's beginning balance plus ending balance divided by 2. So in the case of Apple, we're looking at 171%, which is absolutely incredible. That means that for every sales dollar, they're returning basically $171, right? So very, very impressive. This is great for the stockholders, and this is why Apple stock typically outperforms all of their competitors in the space because their investors see really high returns. Which leads us to our last set of ratios for the evening, and that is our market ratios. Now, for market ratios, we're really looking at the company's overall stock price and what the expected returns are based off of the public's perception. And we use two ratios for this. One's called the price to earnings ratio, and the other one is called dividend yield. And both of these measure the market prospects. So for the price to earnings ratio, we look at this for the future expected growth of the company's stock price. It gives us an indication of the future performance of the company. And the way that we compute this is we take the market price per share of stock at the time, and then we divide that by the earnings per share at the time. In the case of Apple, we got 27.8 price to earnings ratio. Once again, outperforming the industry, which was at 12 at the time. And, just kicking butt and taking names. Apple had $6.16 earnings per share at the time. Very, very impressive. And the last one is called the dividend yield. Dividend yield, we use this to compare the dividend paying performance of different companies. Okay, so side-by-side comparison of companies that pay out dividends. A lot of investors like to compute this ratio when it comes to making a decision about which companies they invest in, especially if those investors are really interested in companies that provide them with a return, provide them with a dividend payment. So in this case, we take the annual cash dividends per share divided by the market share price at the time. And in the case of Apple, it's 0.5%, which is actually pretty decent with respect to a comparison to other companies that pay dividends. So it's respectable. Some companies probably pay a little bit better, like Amazon. They probably pay a little bit better than Apple does with respect to dividends. Nothing wrong with that. It's just a way to attract new investors, really. So that leads us to the conclusion of our ratios. Now, this slide right here, I love this slide because it shows you all of the ratios. What is it, 17 ratios or something that we just worked through, 16 ratios? Um, this slide says it all for us. So I really want you to look at this slide, especially when it comes to helping you on your quiz, because once again, it shows us the summary, just makes it easier for you to do your computations. And then one of the last things I want to talk about is return on equity, which we touched on at some point, but I want to look at this from what we call a DuPont analysis. And for a DuPont, which is the paint company, a long time ago they created the DuPont formula, which is a finance term, but it is also in accounting, and it tells us really about things like the profit margin, asset turnover, and leverage, and we combine this really into kind of one formula. And so the DuPont formula is broken out into these three areas: profit margin, which is net income earned on each sales dollar; asset turnover, which is sales generated on each dollar of assets; and the leverage, which is financing of assets through liabilities. Now, really, what this does is the DuPont formula is taking into effect really the three areas of those ratios that we talked about and combining them into one. Uh, this comes in handy when we do comparisons from one company to another within the same industry. And it also provides really great insight into the return on equity, which of course is the most frequently used financial ratio with respect to dividends and shareholders' equity. Um, so, just to give you an idea of how that formula is put into use, here we have FedEx and UPS, and their their various um ratios that we looked at. And so this is side by side, and we put these into the DuPont formula to be able to give a strong comparison to each. And so, for example, for FedEx, we can see that the return on equity is 16%. We take the profit margin times the asset turnover ratio times the leverage um, uh, index, which gives us 16% return on equity for FedEx. That tells us that FedEx is very good at using their overall equity, um, uh, their investments for equity in a very efficient way. So, not necessarily need to know, but just something that I'd like you to know. It's also important to understand that companies need to be able to continue operations into the future. And so, to understand that, we look at this concept called sustainable income. And so, when it comes to sustainable income, we look at the overall net income and how net income is derived. Net income comes from a couple different areas. It comes from earnings per share, continuing operations, discontinued segments, and other aspects of operating income. Uh, all of these together, we if we use all of these different areas of income together, we call it comprehensive income. And comprehensive income is really important for us to as managers to know because it's in addition to the regular operating income that the company generates. And we can see that in our basic income statement. Income statement, as you know, has your sales minus your operating expenses equals your operating income, minus your tax, minus your interest, getting us to income from continuing operations, plus any income from discontinued operations minus any losses equals net income, right? And then at the bottom, we can compute earnings per share based off of that net income. All of these helps us as managers to be able to make decisions about the company, um, and impacts from these factors on our company. So, uh, it's been great tonight. I sincerely appreciate the effort that you're all putting into this class so far. I think that everything's looking great so far. And so what I need you to do for Sunday night is to complete that chapter 17 quiz. I want you to do it based off of the discussion that we just had. I know that some of you have already done it, so thank you for doing it already. If you have, if not, please try to get it done as soon as you can. Since it's still fresh in your mind, you might want to do it tonight or do it tomorrow just to save yourself that stress from having to do it over the weekend. And also, if you are past due on your LinkedIn Learning Certificate from last week, please make sure you get that into me. And so I'll be happy to grade all that. And I look forward to the rest of the semester with you. I think it's great so far, and I just keep up the positive momentum. Okay, feel free to work ahead if you want to. You're more than welcome to do so. And as always, if you need my help, you can always reach out to me. I'm always going to be here for you. Are there any comments, questions, or concerns from the class that I could help to address at this time? Do you feel
Is the quiz option still, you still get 2 attempts?
Yeah, you still get 2 attempts on the quizzes.
Okay.
So, if you don't feel great about that first attempt, go ahead and try it again. Yeah, good question. Any other comments, questions, concerns, anything at all? No? Okay, awesome. Well, thank you all again so much for your time tonight. As always, I appreciate all of you and all of your efforts. It means a lot to me, and hopefully it means a lot to yourself. Keep up the great work. If you need anything, you could email me, call me, set up office hours, whatever. Okay, I'm here for you. But thank you all so much for your time. Appreciate all of you, and I hope you have an awesome rest of your night. Thank you so much. Take care.
Thank you. Good night.
Thank you.
Good night, y'all.